Do you know which is the most liquid stock in the world? A lot of people come back and say it's Tesla, it's Apple. It is actually India actually innovated the entire concept of gold ETFs in the world. I met a couple of very forward-looking guys who wanted to launch India's first ETF in December 2001. As CEO of Zerodha Fund, I think this is going to be the most exciting time. I've been in the passive market now for the last 25 years and I've seen the benefit of these products. The largest mutual fund scheme in India today is an ETF. I think they're going to see huge amount of growth, in the next coming years, especially for a country like India, which needs more and more simple products. What should I buy as an investor? I'll make it very simple for people to understand. At the end of the day, we have to realize why is it that we want to invest in the equity market. You want to invest, according to me, there are two main reasons. So I tell people, look, split your portfolio in a core and satellite kind of an approach. I think there's one figure that every investor should look at. Is something called as
Hi Vishal, welcome to Power Academy. It's so nice to have you here. We saw so many comments on our videos about ETFs and essentially how to pick the right mutual fund. Do I go active? Do I go passive? And we have been wanting to do a podcast on passive investing for so long. And who better to do this than someone who was in the founding team when the first ETF was formed in India. So thank you so much for taking out the time and joining us here. Let's get started right
Sure.
away.
Thanks for inviting me, Navla.
Great. Vishal, let's start a little bit about your journey. You've been in this industry for a long, long time. Tell us more on that.
Sure. So my love for indices started off in my first job, where I was working for this company called Skindia Finance. Post that, I joined CRISIL in their index division. That company, so that division later got hived off into a joint venture between NSE and CRISIL. Post my stint with this joint venture, I met a couple of very forward-looking guys who wanted to launch India's first ETF, and that's how Benchmark was born. And we launched, Nifty Bees, which was India's first ETF in December 2001.
I've always been curious, right? Nifty Bees, Junior Bees, Bank Bees. What does Bees stand for?
So interesting question, Navda. So at that point of time, when we were thinking of a name, we had a couple of options. So B's basically stands for the BE stands for benchmark, the E stands for exchange traded, and S stands for scheme. So
Okay.
that's how the name kind of came about. We had other options as well, which we struck off because we didn't know how it'll sound. So one of the names that we had thought of at that point of time was BETS, the benchmark exchange traded scheme,
Okay.
but wouldn't have given the right kind of impression about the product, and therefore we chose the name Bees. Luckily, it's become a very popular name in the market.
Yeah, it,
Yeah.
it has a ring to it. I never thought I'll ask the person who actually started that product to tell me what was the story behind it. So thanks for
Yeah,
sharing.
yeah, I'll be happy to share that the gold ETF, India actually innovated the entire concept of gold ETFs in the world.
Oh,
So the conceptualization of gold bees actually happened in India, and at that point of time, nobody had conceptualized gold ETFs. It's just
oh,
that by the time we got regulatory permissions, it was 2007, and that product got launched internationally maybe in 2005 or so. The current journey that I am in as CEO of Zerodha Fund, I think this is going to be the most exciting time. I've been in the passive market now for the last 25 years and I've seen the benefit of these products. So I look forward to the next decade, which I hope will be more fulfilling than what it has been.
great. So let's start with the basic fundamental question. What exactly, Vishal, is an ETF?
ETFs started off, I think, in about 93, 94 or so. And the basic thing about an ETF is it's a mutual fund unit, but it trades real time on the exchange as well. Right.
Okay.
So in a sense, it trades like a stock. Let's take a simple example that you invest in a Nifty ETF, right?
Hmm.
And at this point of time, at 11 o'clock or 12 o'clock in the afternoon, is 1% down.
Hmm.
You actually have the ability to buy it at that lower price. And in case it is up, right, for any, I mean, because of the markets, and you had to sell, you have the ability to sell at a real time price.
Got it. Got it. And since you're talking about, ETF versus an index fund, so index fund has a fixed NAV while ETF can be traded. Could you double click on, is that the only difference? How do they vary? index mutual fund versus an ETF?
So again, as I said, it's just a different structure. Your question is very pertinent in the sense that what should I buy as an investor? I'll make it very simple for people to understand. If you have a trading and a demat account, right, and you have access to the stock markets, and that you are an avid investor and you understand that well, I would say look at an ETF. If you're a person who prefers an index fund structure, a mutual fund structure, where it's easier for you to even do SIPs, then I would say go in for that structure.
Got it. Understood. And since Vishal, you have been, in that founding team when the first ETF was launched, would love to understand, what was the thought process behind creation of an ETF, and back in the day, how did the market responded, and how have you seen that evolve? You have seen the entire journey of ETF.
At that point of time, if you looked at mutual funds in general, mutual funds were picking up at that point of time. I mean, private sector mutual funds had started coming into the market only in the middle of the 90s. And in the beginning of 2000, we had launched an exchange traded fund, which was a kind of a very unknown concept. So convincing investors to go and invest in an index is not an easy game. Luckily, we had institutional investors investing in ETFs, I would say somewhere from 2005 to 2006 or so. And that's where we saw the rise in AUMs in ETFs since then.
Got it. No, fair. I used those passive funds to sort of enter into the market, be comfortable with it, and now, can also explore other financial products. So, wanted to understand on that, right? The whole thing about active versus passive investing. What's your take on how much should we have in active, how much should we have in passive? Any views there?
Again, Navda, that depends on you as an investor. Depending on the amount of risk that you want to take and what your financial needs are, you could accordingly decide in terms of whether you want to have passive or whether you want to have active. I would say that you should have both in your portfolio. At the end of the day, we have to realize why is it that we want to invest in the equity market, right? You want to invest, according to me, there are two main reasons. Firstly, you want to beat inflation, right? And secondly, you believe in the India growth story, right? Two very simple things for you to do. So I tell people, look, split your portfolio in a core and satellite kind of an approach, where the core becomes the basic part of your portfolio. Where, look, I want to take exposure to the Indian market, right? And a passive fund is a very easy way for me to take exposure. It's like this: if I'm feeling thirsty, the easiest thing for me to quench my thirst is to pick a bottle of water, right? It's not necessary that I need to go and pick up a can of Coke all the time, right?
Yeah.
So with water, I'm able to quench my thirst, right? And therefore, with a passive product, right, you're very easily able to kind of achieve those two objectives of beating inflation. That means being invested in the best companies that are there in the Indian market, and also at the same time is cost effective, right? Through that satellite portion of your portfolio, then you can look at what are the alternative avenues of investment. That means you can start looking at active schemes, you can start looking at thematic schemes, you can start even looking at sectoral schemes, or any other kind of asset class that you may like, whether it may be real estate, whether it may be any kind of asset class that you like. I think you should put that in your satellite portion, right? Now the next question then arises is, how much should the core be? How much should the satellite be? I think that's a very individual choice that someone should take. But the reason why I mentioned this is because it's a very good framework for someone to start building a portfolio and using both concepts to your benefit in that sense.
Got it. So, Vishal, as you were talking about, right, which is there are so many schemes out there, right? How do I choose which is the right one? So, in passive funds, given that all of them are tracking, say, the underlying same fund, how do I differentiate which is the right passive fund to pick?
Again, I think there's one figure that every investor should look at, is something called as a tracking error.
Okay.
Right, and that tracking error is disseminated in the fact sheets of all the fund houses that are there. So one could compare the tracking error of the various schemes and generally pick up one which where the tracking error is on the lower side, because that particular fund is then being managed very well. So that's one figure that investors should look at before investing. Yeah.
Got it. For our audience, could you also define like what a tracking error is in simpler terms?
So tracking error is the standard deviation of difference between daily returns of the NAV and the index. So let's take a simple example that today the index has gone up 1%, and your fund has gone up, say, 0.99%, right? So there's a 0.01% gap between the returns of your fund and the returns of the index. Now, that 0.001 is calculated for the entire year. So the difference between the returns, that means the difference between the index returns and the difference between between your NAV, that difference in returns is calculated on a daily basis for 250 trading days, which is 1 year. A simple example could be that there might be a fund which at the end of the day, end of the year has given, and the index has given 15% return and the fund has given 15% return, but the tracking error is high, right? Which means that there have been cases where the fund manager has not been tracking the index, right? There could be an instance where a scheme has given 15% return and the index has given 15% return, but the tracking error is very low, which means that that fund manager has been managing the index and his portfolio very well on a day-to-day basis. Whether it is an index fund or an ETF, the tracking error is disseminated, and that's one figure that all investors should look at before investing.
And where do I see that for Nifty Bees? Because you said for funds, I can look at the fact sheet, which I can see in the
Similar.
in the
So
website.
even ETFs. Remember one thing: ETFs are mutual fund schemes.
Okay.
It is just
they're
that the
traded.
structure, because the structure is listed on the exchange, but at the back end, it's a mutual fund unit.
Okay.
Yeah.
So I can go to the website and I can see the tracking
It's
error.
correct.
Understood. And given that they're traded, how is the liquidity like? For example, is there a situation where I go and want to sell an ETF and I'm not able to?
We have to remember that, look, at the end of the day, any ETF, right, is as liquid as its underlying. Now, I'll give you a simple example. In during COVID time, when there was a lockdown, the physical market of gold was shut, right? Now, most ETFs there at that point of time, which are trading at huge premiums, right? And we had a lot of investors coming to us at the time when at my previous workplace saying that, look, why are your ETFs trading so high? Right, they're trading at 4-5% premium because an ETF is at the end of the day investing in the gold market, and the gold market is shut because of a certain diktat that has been given by the government. There's nothing that anyone can do. Can any investor at that point of time also go and buy physical gold? No, you couldn't buy physical gold for any ETF, right? As long as there is liquidity in the underlying, right, there will be liquidity in the ETF as well. Why? Because you have market makers in every ETF. Now, typically in a diversified ETF, right, something like a Nifty 50 or a mid cap 150 or any of these diversified products, you will generally find liquidity to be better, right, as compared to the thematic ones. Why? Simply because the fact that demand for diversified products is always greater than thematic products, because thematic products are always flavors of the month. So you will find that liquidity comes at some point of time, demand comes at some point of time, but it's not there always, right? But for any diversified product, there's always a market, right? And therefore, people tend to, and therefore, the diversified products are much more liquid. I don't know if you trade in the international markets, but do you know which is the most liquid stock in the world? On the New York Stock Exchange, which one do you think? A lot of people come back and say it's Tesla, it's Apple, but that's not the case. It is actually Spider. So Spider is SPDR. It's an ETF which is based on the S&P 500 index, and that trades, I think, nearly 2 times more than the next liquid stock. Right. The largest mutual fund in the world today is the Vanguard 500. Right. The largest mutual fund scheme in India today is an ETF.
Oh, wow. Which one is that?
So it's the SBI's Nifty 50 ETF.
Oh, is it?
Right. That's the largest mutual fund scheme which is there in the country. Right. Which just shows that, look, the structure, is very versatile, and the liquidity, as I said. If a scheme can become 2 lakh crores in AUM, right, it depends on how much liquidity the underlying has, right? And if the underlying has liquidity, the ETF will have liquidity.
Got it. Fair. So as long as underlying asset, which is the stocks, are liquid, there shouldn't be any problem in liquidating. Got it. Understood. So, Vishal, we were talking about tracking error. That's one of the important metrics to look for when we are choosing an ETF or an index fund. What are the other metrics? Like we were talking about liquidity. Could you double down on liquidity as well? How do I assess how liquid is an ETF?
So, 2 or 3 things that investors can look at. One is that important to look at the liquidity on that particular counter. How do you see the liquidity on that particular ETF? One is look at the traded volumes that are there on that ETF. Also go and look at the counter in terms of buyers and sellers on the counter. These are two very strong indications on how liquidity is on that particular ETF. The second thing is whenever you're placing any order in an ETF, put a limit order instead of a market order, right?
Okay.
A limit order is basically you can define the price at which you want to buy and sell, right?
Okay.
So instead of putting a market order where you say I want to buy say 100 shares and put a market order and the shares come at whatever price there is, you can look at putting a limit order. So let's take a simple example. If the NAV is 100 rupees, you can put a buy order for 100.05 or for 99.05. In a sense, define the price.
Got it.
The third thing is that how do you decide at which price I should be buying and selling? So all AMCs today disseminate something called as an INAV. It's called as an indicative NAV,
Okay.
right? And that indicative NAV is available on the AMC's website as well as it's available on exchange platforms. So you look at that indicative NAV and put a market and put a limit order around that indicative NAV. So that's how you
Okay.
can trade ETFs.
Got it. Understood. This is super helpful. So, tracking error, INAV, and the liquidity.
Yes,
Three
yes.
important things when
Yeah.
buying an ETFs. Great, Vishal. I learned so much today on passive funds. So, thank you so much for sharing that. I'll probably wrap up, with the final question on what's your view on passive investing in India? It's grown. You've seen it grow, multifold. What do you think the future looks like?
So I think there's been a huge change when I see it, say, over the last 25 years or so. Institutional investors were the guys who kind of picked on ETFs and passive products, say, I would say all the way from, say, 2001 to 2015, 16. And now I find the change happening where a lot of small investors, retail investors are now catching on to, ETFs and index funds. And I think that is something that really excites me because my inherent belief is that if we want the next 10-15 crore people to come into mutual funds, the easiest way for them to do it is to come through simple products, right? And passive products are the simplest products that are there in the market, right? They're simple, they're low cost, they're cost efficient, and once people use these passive products to build their nest egg and to build their portfolios, they can then start looking at other products through which they can kind of enhance that return or take a diversified exposure to other products as well. So I think passive products are extremely important, and I think they're going to see huge amount of growth in the next coming years, especially for a country like India, which needs more and more simple products.
Right, right. Great. Thanks, Vishal. It's been great. Thank you so much for sharing so many insights with us. It's been lovely speaking to you.
Thanks a lot for inviting me, Navda. It's been a pleasure.